Hey everyone, welcome to another episode of Mayhem in the Markets, coming to you Sunday, July 23rd, and brought to you by MacroVisor, where we make macro actionable, and Trader Aid, where we help you find your trading edge. 20 years of price changes in the United States show just how expensive a lot of things have become. Hospital services, college tuitions and fees, college textbooks, childcare, and average hourly earnings just have not kept pace. On the other side, discretionary items like televisions, toys, computer software, and then wireless telephone services, which have become more of a utility over time, they've all fallen in price. But these are appreciably overall less important than things like life-saving healthcare and higher education. And this has been a bit of an imbalance, right? You can get a lot of things you don't necessarily need for cheaper, but the things we absolutely do need have become a lot more expensive, particularly hospital services, childcare, and many people need higher education. Now, last Friday was the largest July options expiration ever. And skew has gotten really quite heavy on the call side here. And so what that means, a lot of stock options and single stocks particularly are much more betting on upside than hedging for downside. And with the roll off we had on Friday, we are now in that mode of no more supportive delta and theta decay flows. So that could imply higher volatility in the market. Sentiment is still a bit stretched based off this last reading. It's come down a bit since here, down to about 1.4 now, but it's still stretched because it's over 1, and that does tell us just a little bit about the sentiment overall behind the market. People are quite bulled up. Now, going back just a little while ago, we saw that there was short selling in staples, communications, and infotech ahead of earnings season, and covering in macro products like foreign exchange and rate derivatives, energy stocks, and materials. This all ahead of earnings season. So just keep that in mind with some of the reactions and dynamics that may play out. Gross leverage remains quite high. Last check, it was around 254%. And this is close to the highest levels we've seen in 5 years. And it matters because it amplifies volatility, as hedge funds don't always have both sides of their book balanced out. They're not always delta neutral on risk. In fact, most of the time, they're trying to short weakness and long strength in one way or another, whether it's derived by fundamental, a macro overlay, or a process involving other drivers, quantitative drivers. This implies that sometimes both sides of their book can go against them, and that can amplify underlying market volatility. Auto loans are seeing very high rejection levels, really the highest we've seen since the great financial crisis in terms of year-over-year change here. This is important because this is a lot more, and this shows credit is tightening for the consumer, and it's just one of many areas where we're seeing that. And industries with distressed debt, speaking of tightening credit and problems with credit in general, real estate makes up most of that. A big chunk of that is also in commercial real estate. And within that element, watching office building debt as well as retail building debt is probably going to be key. Much of those two categories are held by the regional banks as well. And when we move over to UK, this is a chart from Goldman Sachs. You can see that mortgages that mature within 5 years or less are the majority. And with rates having moved as high as they have, as appreciably quickly as they have, this is going to create a lot of problems. This is going to have people having to pay a lot more for their home in a short amount of time during a time where costs across the board have gone up elsewhere, whether it's food or energy, and wages have not kept pace. So unfortunately, there's a lot of people that are going to have to potentially deal with a lower standard of living, more borrowing, or otherwise making compromises. And the UK and other countries with short-term mortgages, Canada, New Zealand, Australia, among them, could be hit by this. Looking at money supply, much ado has been made by the year-over-year fall in money supply. Some have said it's the first time it's ever happened. Others have said it's the first time in a long time. The truth is, it's the first time since the Great Depression that the money supply has gone negative year over year. It has happened before, but it's not as big of an ordeal as people may make it out to be. It is important, and it is a yellow flag. It's a warning. But we're also coming from a very elevated level of M2. So we're reverting back to a trend that's more sustainable after the fiscal and monetary impulse, the response to the COVID crash, created an enormous amount of money in a very short amount of time. So a year-over-year fall in money supply as tightening credit conditions and a Federal Reserve that is raising rates and engaging in QT, this sort of outcome is to be expected. Taiwan's chip exports fell the most in 14 years. This is important here because Taiwan accounts for 60% of semiconductors in the world, 90% of the advanced circuitry. And they are seeing pretty meaningful fall. Now, in 2022, that was a robust year for the semiconductor industry, so certainly it would make sense that we could see some year-over-year weakness, but this is material weakness. We see in Taiwan Semiconductors earnings and likely with other semiconductors ahead in this earnings season, that there is still some weakness, that there is a lot of overhang. And if you think about it, it makes sense because on the one hand, semiconductors were much in demand. There was a lot of pull forward of goods demand that happened over the last several years after the stimulus happened. And as a result of that, more people sated their appetite for goods that aren't going to replenish them as they would have otherwise. At the same time, semiconductor companies ramped up production because there were shortages and they wanted to make sure to meet what they thought was a new paradigm of demand. So now they're caught with the hangover after the party and they have to deal with selling this inventory down at lower costs, lower prices, lower cost to customers in a lot of cases. Like it's a great time to build a computer or to get memory for a camera or otherwise, but it's a poor time to be a semiconductor company because margins are getting hit and there's top line deceleration as well as just less people are buying the stuff. China's slowing momentum is a concern as we are seeing what was supposed to be the great big reopening play that carried a lot of the world out of economic weakness. It's starting to falter and stagger, and we've been covering this at MacroVisor for quite a while, talking about how China's really a fade here. In fact, I talked about it on Bloomberg a couple months ago, talking about shorting China, and then not long later, China crossed under the 200-day moving average, and it's continued to meander between losing money and really starting to look like it may enter a bear market. I think the Chinese equity market is at risk because the administration there is essentially autocratic. It's really Xi that makes a lot of these decisions, has cracked down on companies and created a lot of unnecessary pressure. And as a result of that, it's hard for investors, particularly outside of China, to trust their money in Chinese companies because they don't know if there's going to be some random crackdown that could destroy the capital that they've put in. Meanwhile, the government is hesitant to do stimulus, so we haven't seen the fiscal or monetary side really be expansive in nature. And so we're seeing that the Chinese economy is actually risking some level of potential deflation. And this would be concerning also because the four cylinders that the Chinese economy is supposed to fire on now are things like the Chinese consumer, which has not happened, exports, which is not really happening commensurate with expectations, construction, where there's still an overhang and very slow growth and a lack of stimulus, and then finally real estate, where there's a $60 trillion market, appreciably one of the largest markets in the world, but the growth there is just not happening because there's so many developers in a crisis situation in terms of their debt. There's sort of these rolling defaults happening there, as well as the local government funding vehicles, where we're seeing increasing defaults, and they account for almost 40% of corporate debt in China. Wall Street strategists stick to a cautious equity view, perhaps because we've seen such a profound rally year to date. They're a little cautious for the back half of this year. It's the most bearish second half outlook on record. It's probably because a lot of this expansion has been not that many stocks, lots of multiple expansion, not a lot of appreciable gains in earnings, and that probably has strategists a little bit concerned about what that could mean for the S&P. Now, historically, when we have a strong first half, we have a follow through in the second half, but it's not quite as strong as the first half. So we'll see what plays out. On the other side of it, we're getting past some of the more favorable seasonality. And the soft landing narrative is taking root with managed money. Fund managers now believe, up from June to 68% in July, that is the most likely outcome, a hard landing going down, no landing appreciating incrementally. I still believe we have some risks. We haven't yet seen any sort of landing whatsoever as leading economic indicators continue to show us some degree of further negative growth. And that's materially important because to say we're having a landing implies that those indicators are flattening out and starting to rebound, but instead they're continuing to fall further. So I would just suggest it's probably important for those that think a soft landing is happening right now to temper expectations. Of course, this survey is looking out 12 months. Maybe that's a more realistic time frame in terms of what we'll see happen, given the lagged and variable impacts of monetary policy and the large credit cycle we've been in with so much stimulus. It could take longer to unwind than others. And here's something that's really messed up, right? This is Mercedes locking faster acceleration behind a $1,200 annual paywall. This is just a bad look. I just don't like anything about this. But what if there's a situation where you need to get out of a life jeopardizing crisis in your car, and without this $1,200 acceleration, you die or get into some, life changing accident where you're disabled, and it's because you didn't pay this company $1,200. Acceleration in a motor vehicle is not something that should be held behind a paywall. I know that if you can afford a Mercedes, you could probably afford this too, but this just seems wrong on a number of different levels. Like, what if you paid for it and it doesn't register it properly because there's some technical issue and then you can't use it when you need it? It just all of this seems silly and wrong, and just things are going in the wrong direction. And speaking of which, we know and we've talked about AI a whole lot. So here's a great thing, a gift that AI has given us all. A skinny Elon Musk and a fat Mark Zuckerberg, almost as if their bodies have been swapped after the cage fight, right? Hugging, holding hands, running towards each other. So I want to thank you all for tuning in to this episode of Mayhem in the Markets, brought to you by Macrovisor and TraderAid. We've got sales going on both sites. If you want to check it out, 40% off Macrovisor first year for the next 24 hours. And for the next couple days, we've got 25% off TraderAid. You can visit the websites for details. You'll see it at the subscribe section of Macrovisor, and at TraderAid on the main page, you'll see the FedNest Day coupon code. So until next time, everyone, I hope you have a great trading week ahead. It's a lot of great stuff going on. You got the Fed, you got earnings. We cover all that at TraderAid and at Macrovisor. So if you're interested in the earnings, check out our earnings coverage at Macrovisor. If you're interested in navigating the market and the more positioning and flows and sentiment trading for the short and intermediate term trader, check out TraderAid.